Okay, so last up we have, up from Willis Towers Watson, Senior Economist Magdalena Ramada. Magdalena is a Senior Economist at Willis Towers Watson's Research and Innovation Center. She has 20 plus years of experience in R&D and international consulting. Magda holds a PhD in quantitative economics and finance and was Willis's Head of Research and Analytical Services. She currently focuses on strategic consulting for the insurance industry, especially around emerging markets, insurtech, and blockchain and distributed ledger technologies. Magda.
Thank you. Can you hear me? Okay. So actually, I have an announcement to make. I'm not a senior economist anymore at the Research and Innovation Center. I just moved to the business, so now I'm a director at the insurance consulting and technology part of our business. But on a day-to-day basis, I keep doing the same. I've been working on blockchain and insurance for 4 years. And it has been an exciting ride. When I see the things I wrote 4 years ago, there has been a lot of evolution in terms of how we think about it. And I thought, since part of the day-to-day and the sessions we had were about the efficiencies and the synchronization on the back end of things, I would actually talk about the more transformational part of the technology and the potential it has to change our business models. So Tom's last word were actually a very good segue to what I'm going to present now. Okay, so my life used to be a lot easier. I do a lot of presentations, and I never had a disclaimer, but I talk about a lot of firms, and now I have to have you read this. I guess you did, and that's kind of it. I'm not an investment advisor, and whatever I mention in terms of firms is actually just to use cases for you to understand the technology and its potential, and I don't want you to invest in any of these firms in case you wanted to. So, that said, I'll start at the beginning. When I started working on this, I was working on Insurtech, and I was working with some of you to innovate with technology. And the first thing we did was to start a database with insurance companies and Insurtechs. And part of what we were trying to isolate was, why are we seeing so much acceleration on the Insurtech space in the last 5 years? Mainly, because there is a new social interaction paradigm, and it has changed the way we deal with our customers a lot on personal lines, but part of that innovation is now coming into the commercial space. And it implies certain things I'm going to say in a second, but mostly people expect to interact, customers expect to interact with services providers in a different way. Then we have seen transformation of risk, not only because we have new sources of risk like cyber or the cloud, but because those sources of risk are now more interconnected, and we actually have a faster communication from global to local risk, and we have a better way to actually measuring risk and to be able to monitor it in real time. And that has accelerated a space that I used to call Insurtech, and now it's just those dot tech, because we have sports tech and HR tech and wealth tech and rec tech and whatever tech you name. And a lot of the things out there are, can change the industry in certain ways, even though they're not aiming at the insurance industry. So it's a wider ecosystem. That wider ecosystem has, in our database today, some 4,500 companies. I started with 400s and reading news once a week. And now I have like 2 hours a day. And actually, I don't do it anymore. I have a team in China doing it for me. But we're trying to see what that ecosystem is trying to disrupt. And we isolated 7 concepts where they say they will change the industry. The first one, well, just 2. Impact is one of them. Products that have an impact, your data has an impact on the product. So impact is a core concept we see across the ecosystem of startups. Personalization comes with it. It means the product you get is personal to you. We know what you need. We know when you need it. There is something about immediacy, and we have the latest data on our service say people don't buy products because of price mainly anymore, but if they can buy it within 3 minutes, or if they can get a claim processed within 3 minutes. So in personal lines, immediacy is becoming a very strong word in terms of what's driving the thinking and customer centricity. And obviously, for you to have that, you need simplicity. There's no way you can achieve that without a simple product. And you need transparency in terms of what you're insuring and what not. And then there's 2 more concepts that we're seeing. One is data self-sovereignty. Who has the data? Who owns the data? Who monetizes the data? With whom is my data shared? And then ultimately, every single one of those startups is saying, you can trust us and you cannot trust the insurance industry. So those are 7 concepts that I bring up. They are very much there in the Insurtech space. But why am I bringing these concepts up? Because every single one of them can be tackled by different attributes of blockchains or distributed ledger technologies. So many startups that we saw 5 years ago trying to do peer-to-peer insurance or trying to do certain innovations in the insurance space are now thinking, perhaps I should use the blockchain because it will enable me better to do what I wanted to solve 5 years ago. So blockchain has met the Insurtech world in a very impactful way in the past 2 years. And what have we seen? Well, when I started working on this, I came up with these areas and I said, well, this is where blockchain is going to disrupt the insurance industry. We will have smart contracts that are event triggered. We have seen that. We will have increased back-end efficiency. We have discussed it today in the sessions. We'll see more disintermediation. We will be better able to price and to assess risks because of certain type of solutions. And then there will be new types of insurance, and we can reach new spaces. Well, this was 3 years ago. Then the space started to accelerate, and I was looking at something like this. Initially, it was just the logos, and then we were saying, well, we need a taxonomy to actually understand what's going on. Which area of the value chain are they trying to disrupt? Are they agnostic to risk? Or are they looking at every type of risk or a specific type of risk? Are they using other technologies in combination with blockchain? How mature are they? Is the model enabling? And do they want to work with us? Or do they want to actually disrupt the industry and do things in a very different way? So this was 2 years ago. Today, I actually look at it in a very different way, and I think the way we structured the conference today is aligned with this. So, let's see. Okay. No laser. Okay, so a lot of what we have been seeing is that operational improvements and ecosystems of value. That's what we're seeing among the consortia. That's what we're seeing when we're looking at what we discussed in the sessions today about different actors in a semi-trusted environment trying to automate through blockchain or blockchain-inspired solutions, because some of them are actually not blockchains, but they follow the spirit of a distributed ledger, and deal with automation and are using the technology as an excuse to automate processes and to streamline processes that are long due. And I get it, and I worked with some of our clients in some of these things, and I work with B3I, and we have been part of the Maersk project from the beginning. We started discussing it like 4 years ago. So these are projects that are about ecosystems of value and looking at an ecosystem and how it works and trying to generate efficiency and streamline processes using distributed ledger technologies. I think a lot of what's interesting is actually coming in the medium and in the long term. And I'm going to tell you why. So in the medium term, although we didn't discuss it today, there's certain things happening in the ecosystem, in the blockchain ecosystem, that are looking at provenance solutions. And they're looking at identity solutions, and they're looking at ownership solutions. So these solutions are not mature yet, although there's a lot of them. Some are tackling KYC, some are tackling other things. And they are all building on the idea that we will be able to track things like, initially, we tracked the Bitcoins. So people said, well, you know, why do we use this that is able to track the provenance of a Bitcoin and make sure I have it in my wallet and I own it and I can transfer it without anyone intermediating that? I can actually do that for every digital asset. And then people said, well, why digital assets? We can do this with physical assets too, if we can bridge that physical reality to digital reality thing. And then we started doing it with diamonds. And now we have real estate, and we have land registries in Illinois. And we have many things that are real assets that somehow get transformed into a digital asset so that we can put them in a ledger like that. More interesting to us actually is, well, after that, people said, why only assets? We could actually tokenize behavior. We could tokenize risk, and we could tokenize other things that are not assets. And that goes into what we discussed in the previous session, where we're saying, well, you know, we could inject liquidity into the system, because we can actually take a lot of what we have today and tokenize it and put it out in the market. And if something has, you know, if people talk about the ICO boom and every risk associated to that, but I think a key thing about what happened there is it showed us that there was a lot of money out there that the capital markets were not using, period. So we may be able to securitize a lot of things. And we know that can have very bad consequences after subprime, because we didn't have the transparency of what was being securitized and how it was being valuated. But if we have it on a transparent ledger, perhaps that wouldn't have happened. And perhaps we can start securitizing and tokenizing risks and things that we didn't before. So there's a whole new world out there that actually looks at putting on the blockchain things that we haven't even thought we could put on the blockchain. If we have that, and we have identity solutions like I have one on my phone, where I go to Citibank and they do their KYC and they validate my information, my ID and everything else, and then I can walk away with that identity in my phone that has been validated by a trusted actor, which was Citibank. And I go to Bank of America and they don't have to redo the KYC because they can see that Citibank already validated my identity. So perhaps they want to validate other points. And I am building an identity solution that I can now take from one service provider to another. So why can I do that now and I can do it before? Because before we can be the custodians of our own data because we had every incentive to corrupt it, right? So I wasn't trusted with my own data. But now if it sits on a ledger that I cannot corrupt, that it is immutable, I can actually port my own data. So imagine a world where firms and people have these identity solutions building on how they interact with financial services, with education, with many other things based on data from the IoT. And we will have to interrogate the data with actually not storing it. And I think we had a question about it earlier today. So these identity solutions and provenance solutions may change the way we are able to assess risk, because perhaps people volunteer their data to be interrogated because they know we can't store it. And the risk transparency, when those solutions are linked to IoT and to data streaming in almost real time, will also change the way we do things, not only on the private and personal space, but also in commercial, with fleet management and with smart containers and many other things that are connected. So that is the medium term. In the long term, if you actually think that all those things will evolve, and they will because there's a lot of people investing in them, as Tom said, we may be in a world where we can actually do automated risk matching, and where we have tokenized risk that can I just follow and squeeze the whole value chain between risk and capital, because we can track it from the moment it is originated, and we can price it and we can place it in an automated fashion. Can we do that for every type of risk? Well, no, I don't think so, at least not today. But for certain types of risk, we will be able to. So that is how I'm now looking at the blockchain and insurance ecosystem in terms of what type of thing need to happen for it to have a transformational impact. So we are in the stage of synchronization, and we're slowly moving into new infrastructure for new analytics. So for instance, most of our software, when we look at pricing and underwriting, focus on centralized data structures. What if those centralized data structures do not exist in 5 years because the data is atomized and distributed? So we will need things like, homomorphic encryption to actually be able to extract the information of that data point without having it. So we will have to change the way we do our analytics. Firms are actually working on that today. They are working on that new infrastructure for data self-sovereignty and new types of analytics. And then at some point, we may have autonomous insurance. There's a couple of startups that are working on it. They have very interesting protocols. But I don't think this will be translating to most of the areas of risk, and certainly not to those that are mainly relevant to people in this room. And I think it will take a lot of time for that to get to the commercial space. OK, so it is a lot to do, right? And we have structured the way we work in 4 pillars. The first one is we work with incumbents, and it ranges from me going to a board and doing an educational session to actually developing a proof of concept on marine insurance for pharmaceuticals. So working and enabling incumbents is something that we need to do around the blockchain. But then we're also working with those peer-to-peer models and with the startups and with Silicon Valley and with plug and play to understand what those new business models could be, because we need to be able to understand certain models that are different to our business models today, so that at some point, if those become mainstream, we are prepared. Netflix is a great example of that. They used to send DVDs per post, and they used to stream. They didn't know which area the market was going to grow. They were ambidextrous for a while. And then they saw the market move to streaming, and then at some point, they become content providers. So those are the first two pillars. The third pillar is about how do we regulate this in a no-harm regulation type of way. And I think working with regulators, doing the roundtables, having those discussions, working with sandboxes, it really matters. But this is actually the pillar I'm going to focus in the next 10 minutes, which is, well, yes, there's a lot of risks, but should we regulate them all away? Or perhaps should we be able to price them so that we can place them? So a lot of the work we have been doing with Chiara and other people in this room are about insuring the space and understanding what is insurable and what not, and developing models to be able to price it. So part of this is becoming an ambidextrous industry, like Netflix. They were ambidextrous. And the other part is assessing every risk related to what's happening with the blockchain. So where are we on that? This is becoming an ambidextrous industry, and I'm going to focus not on what we already saw, which is what incumbents are doing, but I'm going to focus on the area of peer-to-peer insurance. So initially, those were some of the peer-to-peer insurance that got some headlines and press coverage. And we have Lemonade there, although I do not necessarily consider them to be a P2P insurer, actually, because the P2P aspect of their model was actually regulated away by the regulator in New York. But they wanted to be a peer-to-peer insurance. Then we have these actors. So these are like 7 out of the 200 right now of peer-to-peer insurance models in China. Part of my team is in China, so I get them to research in Mandarin, and I get a lot of insight about what's going on in China. And there's a lot of things going on in China. In less than 3 months, they put together 70 proof of concepts on blockchain after they got the first white paper saying, government wants you to focus on this. So there's a lot of things going on life, on health, on areas where some of our clients would say there's no way peer-to-peer can work there. And then we have the ones in the middle, which are those that are saying peer-to-peer insurance is a powerful idea and blockchain is what we need to enable it. And one of the reasons I bring this up is because these models are the evolution of some of the things we have been talking about, which actually really bring the risk placement to a peer-to-peer platform where there is no underwriter. So what these guys want to do is underwrite without the underwriter. It's code a mutual, code a captive, and then have smart contracts actually dealing with the risk. And they are doing it in areas like product insurance, but they're also doing this in areas of auto and social insurance protocols and crop, and parametric insurance is very easy to code on the blockchain. Okay, so how does the protocol look like? Well, this is why I was saying you need the plumbing, you need the infrastructure. These protocols, this is a summary of the very different protocols we have on peer-to-peer insurance and blockchain. They look at certain components. One is saying we're going to automate the smart contracts as much as we can, sometimes even including the whole way the organization works. We have plenty of examples of that going in a very wrong direction. But the idea that we could have distributed autonomous underwriters is out there, and some people are trying to figure it out and are experimenting with that. On the other side, you need right data. If you want to have smart contract-enabled platforms with no underwriter actually doing anything, you need to make sure that the data that is triggering all those smart contracts is coming from a secure place, right? We call everything differently in the blockchain space, so instead of saying data sources, we say oracles. But at the end of the day, those oracles are data sources. And they will trigger those smart contracts, and we need to make sure that nothing happens in between, that nothing else is triggering the smart contract, or that the data that is triggering it was not corrupted. But we could automate certain types of risk mutualization. using smart contracts and an autonomous type of organization and oracles and data providers and provenance solutions that are tracking diamonds or pork from China or organic fruit, which already exists in the blockchain. And then on the other side, the other two components some of these use are prediction markets, which are betting platforms essentially, betting on things like Brexit and Trump, and they had a great accuracy in terms of prediction, or betting on Kardashians getting divorced and other things. So prediction markets are sitting on a lot of non-actuarial data that has proven to actually have actuarial value. So some of these protocols are actually accessing and leveraging prediction market data. And then if we have identity solutions, we could also build social capital type of solutions. And some of these firms say, well, that is the way I am going to assess and do my KYC. So their idea is that at some point, all these solutions are developed enough for them to be able to just place risk in an automated fashion. And in the same way, Uber says they're not a taxi company, although in certain countries now they are because they own the cars, but initially they were not. These protocols argue they will be a risk transfer administration or community platform, which obviously is different to regulate. And some of these players are saying, well, you know, it's flight delay insurance. But if I don't call it insurance, and there is no insurable interest because I'm not asking you if you're sitting on that plane, you actually are betting on American Airlines getting in time for that specific flight. And I could call this a betting platform, and I'm not an insurance company. So there is a very fluid distinction in terms of how these things are actually put together so that they can transfer risks in a certain way that we as an industry cannot. And I think it's something we need to think about. Then, even with the models that are not really new, we are still generating new risks, or old risks are being transferred to new places. So if you look at disintermediating processes, well, part of these models are actually based on the idea that you don't have a firm or a centralized entity behind the underwriting. And you have unbreakable escrow. And some of these things could be 20 people, but they could be 200 or 2 million. And perhaps, like Mt. Gox, they could fail on various issues. So having underwriting without underwriters raises a lot of questions in terms of who is liable, who deals with solvency, how do we program solvency into smart contract, how do we deal with unbreakable escrow if the oracle is corrupted, and many other questions. Then, even if we just say, well, this is a very easy case, I have done it for a client, we just take a parametric insurance product and we put it on a smart contract. It's very easy. I just need to know if an earthquake happened. I can have a catastrophe insurance type of microinsurance product, and if the earthquake happened and it was about 6 in the Richter scala, it will pay you out $1,000. Very simple. I put it on a smart contract. The smart contract will go to the entity that has the data about the earthquake happening or not, and will trigger a payment if it happened and not if it didn't. But then, you know, I have an increased cyber risk exposure. Most of those data repositories that can be great oracles are not protected. Why? Because the information about American Airlines landing 5 minutes later or an earthquake happening didn't really have a monetary value so that people would actually have an incentive to go and corrupt it. But now I could actually bet on a lot of products that are depending on those triggers and go, and I can't corrupt the blockchain, but I can corrupt American Airlines database, right? And then have it act out, pay me out, and then I'm gone. So unbreakable escrow generates some issues. Most of these oracles are not safe. So people said, well, we can have oracles from the Internet of Things coming in. Because that's safe, it's really difficult to corrupt. Actually, it's not. Data streaming in real time, for whoever is in the security business here or cryptographers in the room, is actually really difficult to secure. So not even a smart container telling me if it's in a war zone or not is a data stream that is difficult, that is easy to protect. So what we're witnessing here is something that was kind of discussed this afternoon, but not really, which is we need more scale and we need more scope, and we're not there yet. And one of the problems is that generates risks today every time we hit that blockchain frontier. Because I can be building a system that is highly resilient, that is encrypted, but if it depends on information or actions from actors that are outside the blockchain, it really, when you hit that blockchain frontier, you can always go there and corrupt the data there, or exploit a cyber risk there. Okay, so then we have data self-sovereignty. And people saying, it's amazing, I have my own data, I can monetize it, I can go to an insurer, to a bank, or to someone else and tell them to interrogate it, to offer me a price and a service. They can have transparency about who I am. I will get something more personalized, and everyone's happy. Well, actually, we don't have regulation to protect people from this type of scenario. And I don't know how many of you watch Black Mirror. If you haven't, perhaps you should, because it just extrapolates technology and its risk to the absurd. And sometimes it's really eye-opening. So we have the dark side of analytics. If we start tokenizing behavior and risk and having identity solutions that are as granular as this, we run into two problems. The first one is a pool of one is not a pool, and all our models are actually averaging and trying to pool risk, and that's how they work. And a pool of 5 is not a pool either. So how are we going to deal with that increase into personalization? Is it sustainable in the long term? Many regulators in the US think it's not. And then, even in the context of me being self-sovereign with my data, if I'm forced to provide it to access a service, we may enter in this whole world of the dark side of analytics where we end up having people that are not insurable and many other things. And we do not have protections for that. So even things that seem innocuous have actually a lot of risk in the long term. OK, so we discussed risk of disintermediating things and risks about automation. And I didn't go into all of these, but there's cyber risk, and then there's also the contractual ones and the governance ones. And there is risk of using new data models. So it seems like this is a very dire future. But those actually are risks that do not apply only to us. They apply to every other industry trying to use this. So I thought people here would be happy about hearing about the new risks, right? Because at the end of the day, all those risks are out there, and perhaps we should think about insuring them. So first of all, the blockchain does not exist. And there's private and permissioned, and there's many variations. And one of the things we have been trying to look at is how do we look at how it is built to be able to assess what risks it has? Because it's very different in a private than in a public setting. And if I have a private one that may be great in certain aspects, it actually is more prone to denial of service attacks and other things. So there is no one blockchain. And if you want to insure a blockchain or the consequences of using a blockchain, you actually need to know exactly how that blockchain or distributed ledger has been built. 2, there is very different risk in the stack. Distributed ledgers have different stacks. And you have the protocol, you have the consensus, but then you also have the application layers, and you have many layers in that stack, and they are all subject to different risks. So you need to think about that if you want to assess the risk. Then it's not the same to use it in the energy industry than in the insurance industry than in the supply chain industry. So there is risk that actually stem directly from where you're applying that ledger. Finally, some of these ledgers have cryptocurrencies behind them that are subject to volatility and many other things, and they're all different. So if there is a cryptocurrency involved, there's risk associated to that. So how many of you insure blockchain risks? Are you sure? Because perhaps you don't know it, but you have some silent blockchain risk in whatever you're insuring, because some of your clients are actually using the blockchain in some of the processes and some of the products you have been insuring. So this is a very long way to say, even if you don't want to apply it, you certainly need to know how it works and what the risks are associated to it, because you may want to insure it, or you may be insuring it already without knowing it, in the same way we have silent cyber risks insured in certain policies. Okay, so this is part of what we have been doing, trying to look at the way we insure this. And I'm not going to go into details, but a lot of these risks are actually known risks that we know how to insure. And yes, we don't have the loss data, but we have other things that may enable us to actually understand and price the risk if we fragment it and if we look at this in a consistent way. So how is the access of that distributed ledger? How do they handle storage? What type of encryptions do they have? What type of consensus? And many other things, so that you have a model that enables you to assess the risk associated to a blockchain or a cryptocurrency. Where does that leave us today? First of all, I think there is one idea you should leave this room with, and it is that the blockchains or distributed ledger technologies are very powerful to generate efficiencies, are very powerful in the way we have been using them, but actually they are a sociological innovation. Why? Because they enable actors that don't know each other, don't trust each other, and have conflicts of interest to interact in a market and transfer value and price value without anyone overseeing what they are doing. And that is a very powerful idea, and that is what can be a game changer. So, this is my first slide, right? How plausible are these longer-term scenarios? I certainly think autonomous insurance is possible, and we have seen some pilots and some proofs of concepts around that idea. Will it disrupt the whole industry tomorrow? No. In 5 years? No. In 10? Perhaps, for certain type of risks. So as we heard this afternoon, a lot of this will have to do with how we evolve in our roles and what we want to do. And for certain type of risks, perhaps we want autonomous insurance, and we want it to be automated. And we want it to be mutualized in that way and be coded into a mutual that is actually dealing with it without us actually having to do anything. So, is it plausible? It depends on many variables. It depends on regulation. It depends on how the infrastructure gets developed. It depends on many things, and I'm not going to forecast how they're going to move forward. So it's very difficult to say if it will happen. But there is a great part of the ecosystem that actually is trying to make it happen. And I think that's something we should bear in mind. Okay, so I used to teach at university, and my last slide was always about homework. So I decided I would have a homework slide today. I am very bullish about this. I've been on this space for 4 years, and I really love it, and I think there is a lot of potential that has to do with it. But obviously, as I said, there are lots of risks as well. So, first of all, these high-stake technologies, including AI and the IoT and the interaction of them and their evolution, are here to stay. And so are these new models of interaction. I think, regardless of what we do, we need to bear in mind that the blockchain ecosystem is very well capitalized. And yes, some of the people that became millionaires overnight bought their Lamborghinis, but then there's also others that actually built firms that have 500 employees and are in 10 countries today and didn't exist 3 years ago. And they are creating value out of it. Why? Because they believe in that new way of social interaction and new way of mutualizing risks and new way of actually accessing finance. And since they really believe in that, they are willing to invest in building something that no one else has an incentive to build. And they are building those provenance and identity solutions and those distributed autonomous organizations for various things. So if I told you that one of the firms doing peer-to-peer insurance on the blockchain, their tagline when they go to talk to insurers and ask for use cases is, we don't care about the premiums. No, we do not monetize what we are doing. No, we are actually coding your product in a way that it's centrally, it's distributed, it's peer-to-peer, and no one's actually making any money out of it. So obviously they're starting to get use cases from the industry for obvious reasons. But imagine that once that is out there, and there is a protocol, because all of this is open source, and everything is shared. So if it's out there, then I can just start coding auto insurance, or I actually have an acquaintance that is trying to do this with health insurance in the US in a peer-to-peer fashion in the state of Arizona, which I think is crazy. But a lot of value will get lost in the process, like in every wave of innovation, but at some point, someone will be able to say, oh, I know how to do this. I've experimented. I know exactly how I need to validate, how I need to deal with moral hazard, and how I'm going to code this into an autonomous organization. So they are there, and they're building the plumbing. So we should start thinking what it means in terms of how we do business. And as I said, we need better models to assess the risk and better governance tool. And there is a saying that says, l'appétit vient en mangeant, which means appetite comes with eating. And we have been out there in London markets and in other markets trying to generate some appetite for cold storage and many other things. And it has been difficult, and there is a huge gap between a crypto company that wants to pay $1 million and London markets that say it's worth 20 million. So we're trying to be a market maker is never easy, but some of this appetite shouldn't be that difficult to get because some of the risks are actually very easy to assess. And you only have to isolate the components that are specific to blockchain and cryptocurrency to price them and put them aside. So say cold storage, we discussed it today. I mean, if it is in a vault and it is like the baseball card that someone mentioned today, yes, there is an issue about putting a value on that baseball card, but there is also issues about, okay, you know, do they have protocols for fire? Are they near a river? Are they subject to flooding? And lots of risks we know that are just standard P&C risks. So perhaps we should start isolating those things that we know and can price regardless of what's in that vault, and then looking at what's in the vault in a second stage. So I think, you know, blockchain has a lot of potential, and the insurance industry is not only under fire because of the way certain things may evolve, but should be responsible for actually looking at these risks and figuring out what's insurable and what's not, and talking to the regulator about what has to be regulated away. And we have a long way to go, but as I said, there's always homework. So I hope this inspires you to actually try to focus your efforts and your interest in blockchain to move the space forward. With that, I thank you. And
thank you. Just before everyone rushes on, just a few final round-up words. It's my pleasure to open this event. It's my pleasure to close it. Thank you so much for your coming today. Conferences are about talking, networking, sharing of ideas. We've had lots of that today. I was so impressed with the Premier opening the session where he talked about the island's commitment to making Bermuda's home for innovation, and it's going to be great to watch that evolve. I would like to once again thank partners, Exceedance and Chain That. We've heard from some of their executives today, and they will all be outside where I hope you'll all join me and them for a quick refreshment. I know it's been a long afternoon. I think you all deserve a drink, and so please have a drink on us. If you can fill out your questionnaires, if you've got a minute, that'd be great. Just leave them on the front desk. And if any of you are into social media, which I'm sure you all are because you're here, hashtag Bermuda on blockchain is the hashtag for this event. But perhaps I could just ask you all to bring your hands together to thank all the speakers and sponsors and for coming today.